I've long stated that cash value life insurance is an excellent bond replacement. Reach into your portfolio, remove the bonds, and replace them with cash value life insurance, and you'll increase your return, lower your risk, lower the standard deviation of your entire portfolio, and experience a better outcome over time. A recent article by PhD economist Pfau out of Princeton lays out the technical argument for exactly why this is the case. In his article entitled "Treating Cash Value as a Fixed Income Investment Choice," Pfau says, long-term investors may find that the long-term net returns on cash value accumulation may be competitive with the fixed income returns a household could otherwise obtain from traditional bond investments. Cash value life insurance provides a way for the policy owner and the insurance company to share the benefits of tax deferral afforded to life insurance, close quote. In other words, because the cash value in a life insurance policy grows tax deferred and can be accessed tax-free by way of a loan, it grows more efficiently than its bond counterparts. Pfau then goes on to give several more reasons why the return within cash value life insurance outperforms traditional fixed income alternative. Let's keep reading. Quote, first, regarding the underlying portfolio of assets. The general account of the insurance company is better positioned than the household to manage the risks involved in earning higher fixed income returns by accepting duration, illiquidity, and credit risk. Actuaries and insurance companies generally can make reasonable estimates about their future claims-related expenses. This allows for a longer-term investment focus with assets held to maturity that can offer higher yields than households could otherwise muster within their own fixed income portfolios, close quote. In other words, because of a life insurance carrier's long-term investment outlook, they are more likely to hold their bonds to maturity. This in turn affords higher yields than an individual investor might otherwise be able to get in their own portfolios. Pfau then goes on to describe the types of investments that are typically held within the general account of the insurance company. These investments include, quote, corporate and government bonds, mortgages, policy loans, a small allocation to equities, and potentially other types of alternative investments. The general account has greater return potential through its ability to invest in longer-term and less liquid assets and to diversify the credit risk of higher-yielding corporate bonds. Households have less capacity to diversify and manage these risks. Asset values for households are too small, their timeframes are too short, and their liquidity needs are too high, close quote. So again, insurance companies have the ability to gain higher returns through their longer-term investment horizons and their ability to tolerate assets that are inherently illiquid. Individual investors who have high liquidity needs don't have the same capacity to tolerate these types of assets in their portfolio. Pfau then goes on to explain how an insurance company's general portfolio, by its very nature, is shielded from interest rate risk. Let's keep reading. Quote, because insurance companies generally hold the fixed income assets to maturity, rising rates will not trigger capital losses, but will allow new premiums to be invested at a higher rate. Because insurance companies use asset liability matching, a rise in interest rates allow subsequent bond purchases to be made at higher yields. This stable value aspect of cash value is a key motivator for using it in the volatility buffer strategies, close quote. Here, Pfau refers to the volatility buffer strategy. In this strategy, investors pay for lifestyle expenses in the year following a down year in the stock market out of their cash value life insurance, giving their portfolios an opportunity to recover before they take further distributions. This can allow the investor to as much as double their safe withdrawal rate from 4% to as high as 8%. Pfau then goes on to explain how the tax-protected nature of a life insurance policy's cash value benefits the investor over time. Quote, as well, fixed income returns must be considered net of taxes. For bonds held in a taxable account, taxes must be paid on the annual interest payments, reducing the compounding growth potential of the assets. Likewise, in a tax-deferred account, taxes must be paid when distributions are made. Cash value within life insurance accumulates on a tax-deferred basis, while the asset can potentially also be accessed without needing to pay any additional taxes, close quote. So not only does cash value grow safely and productively and in a tax-deferred environment, it can be accessed 100% tax-free by way of a policy loan. Next, Pfau discusses how fees are reported on cash value returns versus bond returns. Quote, furthermore, cash value accumulation is already reported net of fees. Fees are internal to the policy and loaded into the stated premium. To be comparable, investment and advisory fees charged on bonds must be incorporated so that bond returns are identified on a net of fee basis, close quote. In other words, traditional bond returns may be overstated given that they are not required to be reported on a net of fee basis. Lastly, Pfau discusses the impact of the life insurance death benefit on the overall return on investment of the cash value life insurance policy. Quote, finally, cash value life insurance also provides a valuable death benefit. If we assume that a pre-retiree needs life insurance and is considering between term and permanent life insurance, the net returns on a bond portfolio would also need to be reduced to account for the cost of term premiums as a percentage of the whole life premiums. Bond investments could only be made with remaining funds after paying for the term premiums covering the pre-retirement life insurance need, close quote. In short, if you haven't retired yet, there's a pretty good chance you need life insurance. And unless you incorporate the cost of the term life insurance policy you'd otherwise be required to purchase, you aren't properly calculating the return you'll be experiencing in your cash value life insurance policy. In this article, Pfau specifically references whole life insurance as the cash value life insurance alternative that yields these results. And while whole life insurance does have its benefits, particularly with the volatility buffer strategy, I think index universal life is a far superior alternative. IUL has a historical track record of providing returns that are, in some cases, 2 to 3% higher than whole life. Furthermore, when you purchase an IUL through the right carrier, you get a guaranteed 0% loan feature. That means that when you take loans in retirement, those loans are guaranteed to be tax-free and cost-free. That isn't a feature that any whole life policy can provide. And yes, IUL companies use the same investment strategies in their general portfolio that whole life carriers do, with the same benefits that ultimately get passed along to the individual investor, though through a slightly different structure and format. In short, Wade Pfau does an excellent job explaining why cash value life insurance should be incorporated into a balanced, comprehensive approach to tax-free retirement. The general accounts of insurance companies have economies of scale, a long-term investment outlook, and the ability to tolerate illiquidity that the individual investor simply cannot muster on his own. Again, if you'll simply reach into your portfolio, remove the bonds, replace them with cash value life insurance, you'll increase your return, lower your risk, lower the standard deviation of your entire portfolio, and experience a better outcome over time. In the next 10 years, I'm looking to put 100,000 Americans on the road to the 0% tax bracket. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes, head on over to davemcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free video series. And if you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.